Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Ross Clark with CIBC Wood Gundy is our guest. Ross, it's always good to talk to you, and it's good to have you back on This Week in Money.
Well, it's nice to be with you, sir.
Got some news going on today. Yesterday, ECB President Mario Draghi says he's going to do whatever it takes to preserve the euro. And today, Chancellor Merkel and President Hollande has said about the same thing. They're going to do everything possible to protect the eurozone. All of this causing what you call an outside reversal in currency markets.
Yeah, there was immediate action yesterday in Europe, so that by the time we walked in here on Thursday morning, markets were already back to life in a big way. A bit of a pregnant pause this morning while Mario got together with the Germans, but about an hour and a half, 2 hours before the close, everything has sparked back to life. Whether they can do anything, I mean, who knows? The details are always, the devil is in the details as we get down to these things. But so far, it's been enough to spark the move off the bottom in the euro, and in turn, a reversal down in the U.S. dollar. The flight to U.S. dollars, the flight to U.S. bonds, all pretty much coming towards an end. You know, you and I have talked here the last week or so just about, from a technical perspective, how both of the currencies, those two main currencies, euros and U.S. dollars, were getting overextended in their moves and due for a correction. Personally, the valuation that I do would say that there is still a long way to go in the next, say, 6 months to 2 years as far as these trends are concerned. I think what we're going to see in the short term is just a pause, maybe a pullback. Invariably, markets turn not because at the top you get some major seller who is absolutely right and gets his position off. It's the fact that you've got all your buyers who have bought and there's no one left to buy.
Yeah.
And I think that's what we're seeing in the U.S. dollar. And the reciprocal side, the sellers in the euro, you had too many people on the one side of the pendulum there, and it's due to swing back.
Let's talk about the euro for a second here. You know, with all this hot air coming from all these politicians and central bankers, the euro just seems to kind of be on life support these days.
Has been, and as I say, I mean, clearly it will probably continue to be. The euro was what? It was a 148 this time last year, down to 120 at the early part of this week. When we take a look at the big picture, the technical on this, as I say, I've got a 2-year target that's down at par, which pauses along the way down clearly have to be taken advantage of, because what are they going to do to try and fix things over there? They're going to end up with their version of QEs. They are going to be printing money and doing everything, as Draghi says, to try and hold the euro together. But effectively, that it's going to mean that the value of the euro, as it stays in, if they can manage to hold it together, will decline in relative to other currencies.
Even seems to be, Ross, some kind of divergence in the Eurozone itself. Here, on the one hand, the ECB is saying they may buy government bonds. Germany's central bank against the idea from the get-go. That ought to be an interesting discussion this weekend.
Oh, yeah. I mean, this quote, this sort of the sterilizing of bond purchases through the securities market program, I mean, everything here is very, very much up in question in terms of what can be done. All of these northern European countries still are of the mindset that they don't want to hand everything away on a platter. That's they need to have some type of controls.
Problem seems to be mainly in the southern areas of Europe. Here's Spain's 10-year back near 7%, an all-time high earlier this week, 7.75% for a 10-year.
Yeah, 7. I think I saw like a 738 or 740 print at some point in the week. It's finishing off the week down at 666. I see for the 10 years, and the Italy's back under 6% at 592. I think sort of a respite pause here within the move. But interest rates, this whole flight in terms of the credit spreads and what's happened, we've seen U.S. interest rates down to 144, I think was the low I saw there in terms of rates, and we're back to U.S. 10s around 155. So the pressure coming off in terms of what we see for selling pressure over in Spain and Italy, and in turn then the buying pressure that was coming into the U.S. Side of the bond market subsiding. You talk about the reversals that we've seen in currencies. It's pretty much universal in terms of other markets as well. With the bond markets, the work that I've got indicated that the bond pricing was very much like the tail end of that silver run we had last year into April, getting very, very much ahead of itself, in need of a very large correction. And the same outside reversal that we've seen in currencies, we're seeing in the long end of the bond market. Bond market went to a new multi-year high as of this week, and it's now closing below the lows that we put in last week. And that's both in the 10-year and it's out in the 30-year bond. So it's only at the front end that you're really not seeing that. And even, I think, just check here. Yep, Canadian bond market the same way. Okay. We're closing now down near the lows that we had 2 weeks ago on the long bonds in terms of Canada. So it's to see a short-term rise, I would say, over the next few weeks in terms of the interest rates on the long bonds in North America would not be a surprise.
We're talking to Ross Clark from CIBC Wood Gundy here on This Week in Money. And Wall Street Journal this week saying the Fed may be moving toward more stimulus. Could be early as next week. That's when the Fed meets next time. And, of course, that's got to affect what's going on with people's perception of the king of currencies, the U.S. dollar.
Well, very much so. I mean, you see with Draghi and his comments and what's happened there, it may be that where a week ago the talk was with the soft economic numbers that were coming out, that the Fed could be moving, and Guyton, listening to Geithner's interview earlier this week, that things could have been coming to fruition through some Fed actions out of next week's meeting. But with Draghi taking the spotlight here in the last couple of days, it may be that just rather than sort of spending your wad right now in terms of doing things, let the discussion and the regarding movements affect the markets, and see how well they do with that. It may be at this point now that the Fed doesn't have to react next week, and that they hold off into September.
Geithner already blaming the mess on Europe, naturally.
Oh yes, and saying that they knew about the problems with LIBOR back in 2008, 2009. Clearly, they chose to put that under the carpet for a while and not deal with it.
So the dollar index today, 82.66 and falling.
Yes, and this is the dollar since May of last year has had three significant rallies during this upside action that it's had, from roughly from 72 up to 84. And we had minor corrections along the way, and my work suggests that we're due now for one of the larger corrections. Okay. So for the dollar index, I love to work with charts, and I've got a series of them here in front of me, and we can make these available to any of the listeners if they choose to contact me next week.
Okay.
I can send them off an email with items that we talk about here regarding the currencies, the bond market, and the equity markets. But what I like to look at is that the markets in minor moves will pull back to short-term moving averages. When they get a little overextended, they'll pull back to the next longer-term moving average, or they move exponentially like we saw in the silver market in the spring of last year.
Mm-hmm.
Well, where the dollar sits right now, it is, in my work, set up for a good correction back to, instead of just a 20 or 50-day moving average, we should now be looking at the 200 to 233-day averages. So for the index, which sits at 82.5 in round numbers right now, the support is probably going to come into play around 79.5 to 80. That it would be a pretty reasonable correction off a high of 85. Putting that in perspective with the Canadian dollar, we could be looking at maybe the top end of the Canadian dollar being around par, and the subsequent correction after that, if the U.S. dollar starts to strengthen again, back down through the 96 level that we saw back in June. Like most items, that June 2nd, June 3rd was a pretty pivotal window for just about everything out there.
So looking ahead, are we going to see more weakness in the euro, more strength in the dollar? What's the long-term picture?
Well, I think as far as the euro is concerned, I think reasonable target becomes something down around par, and the bounce that we might have in here, euro's sitting around 122. There's some pretty good overhead resistance, I would say, in the 126 to 128 range. I'd be surprised to see it get through there.
Okay.
And if that lid does come into play, then look for the next bout of selling to drive us quite a bit lower. There's clearly, with Spain and Italy and Greece in the position that they're in right now, the contrarian in me would say that everyone is aware of the bad news, and so it would be realistic to see a bounce. But over time, unless they can really, really clean this up, and most of us would be surprised to see that, the fundamentals over time should continue to drive the euro down.
Now, dig out your short-term crystal ball for a second. What happens next week if the stimulus is not as grand as everybody expects it to be? What do you think that'll do?
Okay, back to what's been happening, right? The erosion in the markets again.
Yeah.
It's we've had so many moves up in anticipation of there being follow-through on, whether it be an FOMC meeting, whether it having been the Greek crisis really that was coming to a head starting in August through October of last year. Each one of these supposed meetings of the minds within the European community and within the Fed have given life to the market for a short period of time. But the lack of follow-through has, been followed by just an immediate reaction back to the downside.
You and I were,
I think from a currency perspective, failure of anything to happen next week, probably becomes an interim turning point again.
You and I were talking earlier off the air about the number of bears out there versus the number of bulls out there. Share those stats with us that you found.
In terms of, say, the currency markets, we've seen absolute extremes here. Interesting stat I was looking at this morning was the American Institute of Individual Investors, the AAII numbers, and there, we look at both the raw number in terms of the percentage bulls and the percentage bears, which in themselves are not at extremes. However, when you look at the ratio of bulls to bears, it's down to about 30% right now, or bulls to bears, down to 30%. And that's a number that we do a smooth average, a 12-week moving average of this to get rid of the short-term gyrations. But we've only seen levels like this, the bottom in 1998, the bottom in first quarter of '03, into the spring of '08, and also into March of 2009. And so 3 of those levels that were similar to what we're seeing now produced rallies that were good for, a minimum of a year coming off a low. One of them, the one in 2008, was good for a couple of months. So the sentiment numbers, as low as they have been for this last week or so, are supportive to the market. But it's not so much that it's because there are so many bears. It's just that the bulls just don't seem to be out there. And it's what you've got is a lot of sheep, or a lot of ostriches. People just with their heads buried in the sand and not wanting to do anything right now.
Markets ending the week on a positive note this week. Better than expected U.S. second quarter GDP numbers, part of it. And, of course, the rally being based on hopes that central banks are going to support the economy. And by support, of course, we mean print money.
And there's lots of push out there to have the Fed and have the ECB come through with various means of pushing money into the system again. I don't know why everyone thinks that we should have this on an ongoing basis, but it definitely is what they keep asking for.
I always wonder, Ross. I know that this affects currencies, but why would the stimulus or lack of stimulus affect what's going on in markets? I thought they were based on something different.
Well, I mean, stimulus, it's what you've got is you're changing the value of the underlying asset base that you're measuring things with. So much of the move really is not a move up in value as it is a move decline in the yardstick that we're measuring it all in. Interesting that I saw a chart come out from the Federal Reserve just in the last week or so, showing that if you take out the days leading up to the FOMC meetings, that the S&P, which currently sits at 1387, if we take out those days leading up to that, the S&P would only be at 600.
Interesting.
Yeah, so a full half, it would be half of the value that it is had they not been building up towards this. Yeah. And in anticipation that there will be good market, related information sitting there. The key is, once again, though, it gets down to earnings and balance sheets and what are the investors on an individual and institutional basis willing to pay for things. I was looking at it this morning, the TSX. You're sitting here with the index down dramatically off the highs of 2007 and this last year. But we're sitting with earnings that are right back up to the best levels that we've seen in since 2007. But what investors are paying for those dividends and earnings is roughly half. The price-earnings ratio down in the low teens for Canada, and it had, just back in 06, 07, they were up into the high 20s.
Got to look at a couple of U.S. numbers here, Ross. The Dow briefly over 13,000 this week, and the S&P 500 adding 2%, the highest level for both since early May. And we can't forget that this is the summer of the U.S. election. And how does that affect what's going on? Yeah, you typically end up coming off, you get your momentum high into the February-March period. Quite often the price high can happen in early May, which becomes the classic in terms of the sell in May, go away phrase that everyone is familiar with. The research that I've done shows that you will typically get at least one sell-off into out of that April period into a May-June low, which was what we've seen. And then in most instances, you will have a choppy action from there through the summer with another correction back to test the lows. So at this point, we put in a mid-May low, put in a marginally lower low June the 2nd. As I say, that happened in concert with currencies and other markets. So we've been stair-stepping up since then. The chances of us sort of blowing through on the upside here on a
a consistent basis and holding the gains are against the odds when we take a look at the seasonal pattern for this type of a year. The chances of us running out of steam here in the next week or so, I think, are reasonably good, and going back down to test the support. But it's a whole period, basically May through the end of August, that tends to be stuck in a broad trading range, and this year seems to be no different.
A lot of folks on the sidelines. Are we still looking at some kind of a correction later on this summer?
I'm still hoping for one, and I think it can become the opportunity to step up to the plate and take advantage of things. That's from a broad market perspective. Mm-hmm. Clearly, the companies with strong dividends, strong cash flows that are doing well are continuing to move higher. We don't talk about individual stocks during our interviews, but there are a number of Canadian and U.S. stocks that are paying those 3 to 6% dividend yields out there that are just continuing to attract money week after week, and they're stair-stepping up, while over on the other side, mostly I would say the material side of the equation, your mining oils stocks have been on the other side of the pendulum, feeling the pressures.
Great advice from Bob Hoy earlier this week. Basically, sell the rallies is what he's saying.
Yep, I think that that's realistic, and it's for everyone. They need to do what lets them sleep at night, and if you are looking, if you have a portfolio that is subject to market fluctuations and really feels the volatility of these swings, yes, during the good times, you want to take money off the table so that when you get opportunities like we saw last September, October, that you've got the cash to go take advantage of it.
We do not mention, as you said, individual stocks, but I got to extend an arm around the shoulder here to anybody who owns Facebook. The stock hitting an all-time low this week, down almost 20% this week, 40% below May's IPO, Ross.
I know.
Ouch.
I mean, this is it's disappointing for any of those who were early buyers who thought that just what they liked from a personal point of view in terms of how they like to spend their time or what knowledge they had about something, that it would actually equate through in terms of being a good investment. I mean, we always say that not every good company is a good investment. And this goes to show that not every, we don't know how good a company Facebook is, but, just the fact that there was so much hype going into this thing, you had to question it all along.
I guess it reminds us that it's sometimes nuts to focus on the long term. We're only talking about a time frame of 3 months here, right?
Yes, but disheartening for anybody who did get on board with this, and it's difficult when you have if you want to invest in something. For me, I like to look at charts, so I look at a longer, and I want to see a time frame where a company's been around for a while, so I can see the types of patterns that it moves with. If you're trying to evaluate something from a fundamental perspective, you want some leadership from the company. And a lot of these companies have been slow in providing leadership in terms of advice as to what their forward outlook is. So from a market perspective, I think you have to be very careful with those type of things.
You're listening to This Week in Money. Russ Clark from CIBC Wood Gundy, our guest. And gold up over $1,600. It's gained almost 3% this week, on track for its biggest weekly gain in 2 months. That looks pretty good to me.
It is good. It is part of the seasonal pattern. Gold loves to have a rally at a point during, well, I guess overall, we tend to put in lows in the summer, and historically, as the gold has moved through the latter part of August in through September and early October, you've had a good seasonal run. So much of it was centered over the years around the Indian wedding season. The last few years, I would say that the monetary aspect of it has had even a greater influence in terms of price action. One thing that has shown up over the years is that out of the initial low, you tend to get a good spurt to the upside once you've had an initial breakout, and I consider 1605 to have been the breakout of this 4-month consolidation in gold.
Okay.
And I come up with a series of price measurements in terms of how far we can rally at this point. I don't see just a blazing bull market right now. I think what you're into is still a broader consolidation phase, so that if I take a look at the last 4 months and take a look at the width of that pattern, and I take a look at how far we've broken from the February 29th high, a Fibonacci, a 61% retracement level would take us back to about 1692.
Okay.
If I take a look at the channel that we've been in and I look at some speed lines, looks as though 17.25 would become the lid. So I think that would be a realistic target. And when you look back on these July-August spurts that we have to the upside, they're typically fairly fast. They take a week or two. They tend to then run out of steam, and they come back to test their breakout levels. So if we did something in the order of a 1690 to 17.25 run here, I think you've got to be looking at then another pullback to see how it holds around 1605.
Pretty good week also for silver, Ross, hitting a 3-week high, 27.85 earlier this week.
Same type of thing. Ratio really hasn't done a lot in terms of gold silver. It's still pretty steady. It's and that's another one of the keys. If this thing really had a lot of steam behind it, I would say that the silver should be outpacing gold. But at this point, there's really no big leadership. It's the two of them are moving along in tandem. As I say, if silver had been maybe outpacing gold, by on days where you're up 1% in gold, if we had been up 2 or 3% in silver, that would have been a far, far more bullish sign. I think what we have here is just a normal rally, not something of the magnitude that we saw in the first and second quarters of 2011.
If you would like a copy of the charts that Ross Clark has been talking about today, it's ross.clark@cibc.ca. Or we could phone you. Remember we used to do that? Use the phone?
Back in the olden days.
Yeah. How about a couple of phone numbers we can contact you at?
The 800 number here in Vancouver is 1-877-331-5122. My direct line is 604-661-7759.
Ross, thanks for talking to us today.
Always welcome.
This Week in Money is archived online at talkdigitalnetwork.com.
Dan Denning is editor of the Daily Reckoning Australia. He's online at dailyreckoning.com.au. And he joins us today from right here in Vancouver at the Agora Financial Investment Symposium. Hey, Dan, welcome back to This Week in Money.
Thank you, Phil.
Good to have you here. This year's theme, Innovate or Die, Empire at a Turning Point. Are we talking about any specific empire or just empires in general here, Dan?
Well, I think the consensus is that the U.S. empire is at a turning point. But as I said in my remarks to the conference yesterday, it reminds me of Yogi Berra's famous quote that when you come to a fork in the road, take it. And I think the point that a lot of speakers have made is that that's a big idea, and there's nothing individual investors can really do about the decline or the rise of any empire. So you just have to focus on your own investments.
So we all have to adapt to change. How do we adapt, and what kind of things should we be looking for ahead?
Well, I think in this case, it starts with being honest and candid about the size of the fiscal problems in the United States, or in the case of Canada, the relative strength of the government and the political stability and the favorable relationship that Canada is developing with China. So, one of the things that I like about living in Australia is Australians are very direct when they talk. And a lot of people at the conference here have been very direct because this is not a time, even though we're in an election year, this is not a time where you can afford to be dogmatic or ideological in your investment decisions.
We've got some great speakers lined up here who've talked so far, and you just listen to some of the titles of some of these speeches that give you kind of a flavor of what's going on. Byron King, Stock Picking Amidst the Ruins. Doug Casey, The Greater Depression, Worse Than Even I Think. And Barry Ritholtz, This Is Your Brain on Stocks. Some good speakers and some good material here.
Yeah, I think everyone has tried to bring a perspective to the discussion that helps people make better decisions. And when I spoke, I think what I said, it's somewhat controversial because this is an investment conference and people want investment ideas. But my biggest observation was that we don't have free markets. And prices in the stock market aren't real prices right now. With the actions of the Federal Reserve and other foreign central banks, the price signals you would normally get from a stock index that says, yes, it's a bull market, yes, it's a bear market, buy, sell. I myself think that those are not to be trusted right now because there's so much intervention by the monetary authorities in the markets. But not everybody agrees with that, and obviously people in the resource sector and in the energy sector in particular think that those sectors are relatively independent of what's going on politically. I don't know if that's true, but it's certainly a valid argument.
We're talking to Dan Denning from Daily Reckoning Australia here on This Week in Money. And I love the title of the speech you gave here, Dan. Platypus Rex, End Times Investment Wisdom from the Duck Build.
Yeah, well, I actually spent the first 5 minutes of my remarks attacking the title of the conference because it's a movie quote anyway, but I said studies show that 98% of people will die at some point in their life. Obviously, we're all going to die, so the idea that we must innovate now or that the nation must innovate quickly to accommodate a competitive world, I think is not a helpful metaphor for the situation people are in. So I chose adaptation, and I chose the platypus because when you see things in nature, they only exist if they promote your survival. And the platypus has lived, for millions of years in Australia, which is fairly hostile to animal life. Yeah. And all of its features, the duck bill, the beaver foot, or the beaver tail, the webbed feet, the venomous little spike that it has on its back foot, those are characteristics it's acquired to survive. And I think that's what investors need to think about now is how can I adapt my strategy, adapt my behavior to survive? Because we're in a market where capital gains are secondary to capital preservation. And, I think other people would have different strategies, but I use the platypus to convey that point that adaptation is really the point here, not innovation.
Some of the mainstream ideas that we've kind of grown up on with investing, Dan, are rapidly being discarded. I guess among those, the biggest, buy and hold.
Yeah, well, someone showed a chart yesterday that showed the average holding period now is a ridiculously short period of time. And I don't know why that is, but one of the reasons I offered is that with the media now and the internet, which is great for a lot of things, the fact that we can have a conversation, you can put it up on your website, and people can listen from anywhere in the world, that's outstanding. What isn't outstanding about the 24/7 media cycle is it's created the impression that every single piece of new information must be immediately evaluated and factored into the price of securities. And so that's made investors extremely reactive, and it's shortened their time horizons. And, of course, interest rates have done that as well by pushing down interest rates on bank deposits and on bonds. I think the Fed has forced investors to be extremely reactive. But I think that explains why the buy and hold mantra doesn't work anymore, because things change so quickly and we've become so reactive, and the yields that we get from what we thought were safe investments are so low that people change strategies quickly. And of course we know that raises your transaction costs, and you start to make decisions emotionally, and then things go downhill pretty quickly.
How can I take what the platypus has taught us and adapt my investment strategy for the future? What do you think?
Well, that's a good question. Someone asked me, one of the questions on the panel last night was, if you could be any animal, what would you be, or what animal best describes how investors should be? And I changed my answer because I said the platypus exhibits adaptability, but one of the most resourceful and adaptable animals on the planet are human beings. And it's not because of any physical trait that nature gave us. It's because we have a brain. and we're allowed to use it and think critically and make judgments and make decisions. So I think that's the purpose of conferences like this, and really that's what we try and do over 3 or 4 days, is, and what everyone can do from anywhere really, is take some time to sit down and look at what your goals are, whether they're financial or non-financial, and really put some critical thought into it, and then make your decisions. But don't make your decisions don't wait until it's too late, until the news cycle forces you to make a move that you're not really sure about.
Speaking of the news cycle, U.S. stocks rallying today, Dan, after ECB President Mario Draghi said he's going to do whatever it takes to preserve the euro. And here's Neil Ferguson in his Big Six. Question number 2, can Europe avoid a Jenga moment?
Yeah, well, there are two aspects to that I think are noteworthy. First of all, the Dow did move up immediately after that, and everyone says, "Oh, that's great. The stock market's going up. Everything's fine." The Dow isn't a real price signal anymore. It's a price-weighted index. So the stocks that influence the direction of the index are stocks that have triple-digit share prices. So it's not an indicator of anything, and I think people should learn to ignore it because it's useless. But what is interesting about what Draghi said is that he's essentially in the same boat as the Fed. And what we need to remember is that they are fighting for their life in terms of the system that benefits them and that they're a part of. The dollar is their product. Fiat money is the product of central banks. And of course they're going to do everything to try and perpetuate that system because that's their product. If they were a business, which they're not, that would be what they give the public. So we shouldn't underestimate the creativity and imagination and the tenacity of the people who have a lot invested in this monetary system.
We're talking to Dan Denning here on This Week in Money. He's at the Agora Financial Investment Symposium. And you and I were talking earlier, Dan, that it's interesting that the mood, I guess the emphasis has changed this time around from basically a resource-type symposium to a lot bigger macro kind of economic idea.
Yeah, that's true. I think that the decisions that we had to make 3 or 4 years ago, which was the last time I was here, was 2008, and of course that turned out to be the top in the resource market, and the oil price was close to $147, and then it crashed, and we saw the same thing happen with almost the entire commodity complex. But at that time, there was still a kind of a gap between demand for emerging markets for resources and the ability of the major commodity producers to respond with new supply. And that gap has closed because new production has come online and growth has moderated. So there's probably, you're seeing profit margins shrink for BHP and Rio Tinto. Still very profitable, but doing it on volume, not on price. So this year, I think the conversation is a lot different. It's about the contest between the public sector and the private sector, and really how much larger public sector deficits are going to get before they have a major impact on the economy, which they already have.
A lot of great speakers at the symposium this time around. Friends of ours from Howe Street, Bill Bonner, Chris Mayer, Doug Casey, Brent Cook, Barry Redholz is there as well. And a guy you just finished listening to, Jeff Tucker. He's got some terrific books here. Listen to these titles. Bourbon for Breakfast and It's a Jetsons World. Both basically say the same thing, that miracles come from the private sector, and the government, the state, manages to screw up almost everything it touches.
Yeah, Jeff gave an interesting speech, and I don't think a lot of people would disagree with what he said, that the private sector has been the engine of a lot of innovation and really improvement in standards of living and productivity and the selection we have as consumers. But I think there's a lot of anxiety right now that Western countries in particular are sort of have lost their competitive edge, that we don't have free markets anymore. We don't seem to encourage business, small business, and entrepreneurialism. Banks get favored. Large institutions get favored by their political supporters, and that the engine, the DNA of the success of the Western industrial economy is sputtering, and people don't quite know how to fix it. So I think it's a legitimate way to look at the world, and obviously the theme for investors is to try to identify enterprises that create value and own them as shareholders. But I think that's really it's a hard argument to make when markets aren't working, and my view is that they're not working very well.
Dan, while the engine sputters, here's Neil Ferguson talking about 6 killer apps and basically saying that China and India have downloaded these apps, that they're helping them to gain and even overtake the Western industrialized countries.
Yeah, it was an interesting speech. I was familiar with that idea, the killer apps. I'd seen it on television, and he did a review of it. And then he also asked 6 questions that he thought were really important for the world going forward, which to me actually was the more interesting part of his speech.
Mm-hmm.
But we don't. This is something in Australia that I hear a lot. That when Western economists and investors criticize the emerging market, they're doing so from their own, obviously their own perspective.
Sure.
But given the last 3 or 4 years, we don't have a leg to stand on when we're criticizing those economies. But I think that his points about what it takes to create prosperity is a valid point. And there's still some major barriers in countries like China and India to be fully competitive. But at least on a GDP basis, they're already there. China's the second largest economy in the world, and will probably pass the U.S. in the next 3 or 4 years. And investors have to say, what are we going to do about that? And it requires people to do things they've never done before, like buy foreign stocks, rebalance their portfolios to accommodate where the growth is coming from.
Should we change the idea of emerging markets to mature markets in these areas?
Well, that's true. I think the guy who from Goldman Sachs, Jim O'Neill, was the one who coined the BRICS term, and then he's come out with a new book, which I haven't finished yet, but I saw an interview with him, and O'Neill said that when you look at a country like South Korea, and you look at GDP per capita and the number of patents and innovations and exports, this is a developed economy. This is not an emerging market. So it's a nice little basket where we can put all those countries in the same basket, and we think we understand what's going on. But the world has moved on since people started using that term. And these are more developed economies than they were before, which is good news for investors because there's world-class companies in those places that you can own, but that requires people giving up that idea that there's somehow investment backwaters with unstable political regimes and risky currencies.
Dan Denning, editor of the Daily Reckoning Australia. He's online at dailyreckoning.com.au. Hey, Dan, it's good to talk to you again.
Thank you, Phil. Thank you for calling me up. I always enjoy speaking with you, and Vancouver's been awesome. Canadians are always super nice, so thanks to Vancouver for putting on a good show.
Thanks to our guests, Ross Clark and Dan Denning. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.